Imagine waking up tomorrow morning, reaching for your phone to check your bank balance and finding nothing. Not because you've been hacked, not because of a technical glitch, but because every bank in the world has simply ceased to exist. Your salary that was supposed to arrive today, gone. Your mortgage payment? Irrelevant. The money you've been saving for 20 years vanished into the digital ether. Here's the question that should terrify and fascinate you in equal measure. If all banks disappeared overnight, would your wealth still exist? And more disturbingly, did it ever truly exist in the first place? This isn't just a financial crisis scenario. This is a philosophical paradox that strikes at the very heart of what we believe about value, trust, and the invisible architecture that holds modern civilization together. Welcome back to The Economic Philosopher, where we explore the hidden frameworks that shape our economic reality and challenge the assumptions we take for granted every single day. Today, we're conducting what philosophers call a thought experiment, a mental simulation that strips away the comfortable layers of normalcy to reveal fundamental truths about the systems we inhabit. We're asking a question that sounds absurd until you realize it's actually happened before in various forms throughout history and could, under the right catastrophic circumstances, happen again. The problem we're confronting today is this: we live our entire lives operating under the assumption that banks are permanent, that money is real, and that the complex financial system supporting global civilization is somehow as solid as the ground beneath our feet. But what if it's not? What if the whole thing is far more fragile than we've been led to believe? What if the emperor, as the old tale goes, has no clothes? By the end of this video, you'll understand not just what would happen in the immediate aftermath of a complete banking collapse, but, more importantly, why the psychological, philosophical, and economic foundations of our world are built on something far more abstract than most people realize. You'll see why trust isn't just important to banking. Trust is banking, and you'll gain a framework for thinking about value, exchange, and human cooperation that will fundamentally change how you see money forever. This is going to challenge some deeply held beliefs. So let's begin. To understand what would happen if banks shut down tomorrow, we need to understand what banks actually are, and that requires us to look backward. Because banking, despite feeling modern and technological, is ancient. The first banks emerged in ancient Mesopotamia around 2000 BCE, where temples and palaces provided safe storage for grain and other commodities. The innovation wasn't storage itself, it was the receipt. When you deposited your grain, you received a clay tablet documenting your deposit. That tablet could be traded, transferred, used to settle debts. The grain stayed in the temple, but the representation of the grain moved through the economy. Notice something crucial here. From the very beginning, banking involved a separation between the physical commodity and its representation. This is what philosophers call the map-territory distinction. The map is not the territory. The receipt for grain is not the grain itself. But in a functioning system built on trust, the map becomes functionally equivalent to the territory. You can live your entire life navigating by maps and never really confronting the territory beneath. Fast forward to medieval Europe, and we see the emergence of banking as we recognize it today. Italian merchant families like the Medici created networks of branch banks across Europe, facilitating long-distance trade through letters of credit. A merchant in London could deposit coins with a Medici bank and receive a letter allowing him to withdraw equivalent value in Florence, minus a fee for the service. This was revolutionary. It meant you could move value across space without physically moving gold or silver, which was dangerous and cumbersome. But here's what's philosophically fascinating. These systems required something that cannot be manufactured or enforced, only earned and maintained through reputation over time. They required trust. When a merchant accepted a Medici letter of credit, he was trusting that the Florence branch would honor what the London branch had promised. He was trusting that the Medici family valued their reputation more than the short-term gain of defaulting. He was engaging in what economists call a repeated game, where future interactions discipline present behavior. This is where we encounter our first historical example of what happens when that trust breaks. Bank runs. The oldest recorded bank run dates back to 1326 in the Republic of Venice. When rumors spread that certain banks were insolvent, depositors rushed to withdraw their funds, and because banks operate on fractional reserve principles, keeping only a portion of deposits on hand while lending out the rest, they couldn't meet the sudden demand. The banks collapsed. Wealth that existed on paper yesterday simply disappeared. But the most instructive historical case for our thought experiment is the Great Depression, particularly the period between 1929 and 1933. In those 4 years, approximately 9,000 banks failed in the United States alone. People's life savings vanished. Businesses couldn't make payroll, families lost homes, the money supply contracted by roughly a third. And here's what's crucial to understand. This happened not because the physical productive capacity of America had somehow disappeared. The factories were still there. The farmland was still fertile. The workers still had their skills. What disappeared was the medium of exchange, the social technology that allowed all those productive elements to coordinate and transact. The philosopher John Searle has this concept called institutional facts, facts that exist only because we collectively agree they exist. Money is the ultimate institutional fact. A dollar bill has value not because of its physical properties. Cotton and ink are nearly worthless, but because of collective intentionality, we all agree it has value, and that agreement makes it so. During the Great Depression, that collective agreement began to fracture, and reality itself seemed to shift beneath people's feet. The government response is telling. Franklin Roosevelt declared a bank holiday in 1933, closing all banks for 4 days while implementing emergency legislation. But more important than any policy change was what Roosevelt did psychologically. His fireside chats explained the banking system to ordinary Americans, rebuilt trust through transparency and reassurance, convinced people that it was safer to keep money in reopened banks than under their mattresses. He was, in essence, performing a collective ritual of restoration, rebuilding the shared belief that made the system function. This historical foundation teaches us something profound. Banks aren't really buildings or institutions in the physical sense. They're nodes in a network of trust. They're collective hallucinations that we agree to maintain because the alternatives are worse. And when that hallucination breaks, when the collective agreement fractures, the consequences aren't just economic, they're existential. Now we need to go deeper into the philosophical foundations that explain why the disappearance of banks would represent not just a financial crisis, but an ontological crisis, a crisis of being and existence itself. Let's start with Plato's cave, one of the most famous thought experiments in Western philosophy. Plato imagined prisoners chained in a cave, seeing only shadows on the wall, believing those shadows to be reality. When one prisoner escapes and sees the actual objects casting the shadows, he realizes everything he believed was merely a representation of something more fundamental. Here's the disturbing parallel. Modern money is shadows on the cave wall. When you check your bank account and see a number, you're not seeing money. You're seeing a representation of a representation of a representation. That number represents a database entry, which represents a claim on bank reserves, which themselves represent claims on central bank. Reserves, which represent nothing but the government's promise, backed by its taxing authority, and ultimately its monopoly on violence. We're several layers deep in abstraction, and most people never think about what grounds any of it. The German philosopher Georg Simmel wrote extensively about money in his 1900 masterwork, The Philosophy of Money. Simmel argued that money represents the ultimate abstraction in human society. It's pure exchangeability, pure potentiality. A $10 bill isn't $10 worth of bread or gasoline or housing. It's $10 worth of anything. It's frozen optionality. This makes money extraordinarily powerful as a social technology, but it also makes it extraordinarily fragile because it exists entirely in the realm of belief. Simmel observed that as societies become more complex, we develop more abstract forms of money. We went from commodity money, gold and silver, to representative money, paper backed by gold, to fiat money, paper backed by nothing but government decree, to electronic money, which isn't even paper, just data entries in computer systems. Each step is a move away from tangible reality toward pure abstraction. We're now at the point where roughly 90% of all money exists only as electronic records. If banks shut down, that money doesn't go somewhere else. It simply ceases to exist because it never existed as anything physical to begin with. This brings us to a concept from Berkeley and later phenomenology, esse est percipe. To be is to be perceived. If a tree falls in the forest and no one hears it, does it make a sound? Here's the banking version. If your bank account shows a balance but no institution exists to honor that balance, Does the money exist? The philosophical answer is no. Money has no independent existence apart from the social institutions that recognize and honor it. But we need to distinguish between different types of value here, and this is where Aristotle becomes helpful. Aristotle distinguished between use value and exchange value. A hammer has use value because you can build things with it. That value exists regardless of whether markets exist. But a $100 bill has only exchange value. It's valuable only because others will accept it in exchange for things with use value. If everyone stops accepting it, it becomes worthless paper. Its entire value is relational, depending on a functioning system of exchange. Now consider what philosophers call the problem of induction, most famously articulated by David Hume. Just because the sun rose yesterday and the day before, and every day in recorded history, doesn't logically guarantee it will rise tomorrow. We assume it will based on inductive reasoning, but that assumption isn't logically certain. Similarly, just because your bank honored your withdrawal yesterday and has always honored withdrawals, doesn't logically guarantee it will tomorrow. We assume it will, but that assumption is grounded in trust and probability, not certainty. This connects to the philosophy of risk and uncertainty. The economist Frank Knight distinguished between risk, where you can calculate probabilities, and uncertainty, where you can't. Bank failure in a normal functioning system is a calculable risk. You can look at capital ratios, stress tests, insurance schemes. But systemic failure, all banks shutting down simultaneously, is genuine uncertainty. We can't calculate its probability because we don't have enough instances to create a probability distribution. It's what Nassim Taleb calls a black swan event, something outside our normal framework for thinking about risk. The social contract theory of Hobbes, Locke, and Rousseau is also relevant here. These philosophers argued that civil society exists because we've implicitly agreed to surrender certain freedoms in exchange for security and cooperation. The banking system is a kind of financial social contract. We agree to deposit our wealth in banks, surrendering direct control in exchange for security, interest, and the convenience of participating in a complex economy. But like any social contract, it only functions if both parties uphold their end. If banks fail en masse, the contract is broken, and we revert to what Hobbes called the state of nature, where life becomes solitary, or nasty, brutish, and short. Finally, we must confront the phenomenology of economic reality. The phenomenologists, like Husserl and Heidegger, were interested in how things appear to consciousness, how we experience reality. For most people, money appears as something solid and real. The numbers in your account feel like they represent something tangible. But this is what phenomenologists call the natural attitude, taking the appearance for reality without questioning the structures that create that appearance. A phenomenological reduction, stripping away those assumptions, reveals that money is a shared intentional object, something that exists only in and through our collective directing of attention and agreement. If banks shut down tomorrow, we wouldn't just lose access to our accounts. We would experience a kind of ontological vertigo, a sudden recognition that what we believed was solid was always vapor. The ground of economic reality would reveal itself to be groundless, and that psychological and philosophical shock might be more devastating than the immediate practical challenges. Understanding what would happen if banks shut down requires understanding the psychology of trust, panic, and collective behavior, because the immediate aftermath wouldn't be rational, it would be psychological, and psychology operates according to different rules than economics or philosophy. Let's start with what psychologists call availability heuristic, identified by Kahneman and Tversky. We judge the probability of events based on how easily examples come to mind. For most people in developed economies, bank failure isn't psychologically available. It hasn't happened to them or people they know, so they dramatically underestimate its possibility and are unprepared when it occurs. This is why the first hours and days after banks shut down would be characterized by disbelief and denial. People would assume it's temporary, a technical problem that will be fixed shortly. But as hours became days, a different psychological mechanism would activate. Loss aversion. Kahneman and Tversky demonstrated that losses loom psychologically larger than equivalent gains. Losing $100 hurts more than gaining $100 feels good. In fact, research suggests the pain of loss is roughly twice as psychologically powerful as the pleasure of gain. Now imagine not losing $100, but losing access to your entire life savings, your ability to buy food, your capacity to pay for shelter. The psychological pain would be overwhelming. This connects to what psychologists call learned helplessness, a concept developed by Martin Seligman. When organisms experience situations where their actions have no effect on outcomes, they often become passive and depressed, even when opportunities for escape become available. In a scenario where banks have shut down and your money has effectively disappeared, you would likely experience profound helplessness. All your years of responsible saving, all your careful financial planning, revealed as meaningless. This learned helplessness could prevent rational adaptation and problem-solving precisely when those would be most needed. But the real psychological danger isn't individual. It's collective. This is where we need to understand the psychology of crowds and mass panic. Gustave Le Bon wrote about this in his 1895 book, The Crowd, a study of the popular mind. Le Bon observed that people in crowds often behave very differently than they would individually. Emotions become contagious. Rationality decreases. People become susceptible to suggestion and prone to extreme actions they would never consider alone. We saw this psychology during the 2008 financial crisis when depositors lined up outside Northern Rock Bank in the UK. Desperate to withdraw their savings, the rational thing, from a systemic perspective, would have been for everyone to stay calm, as panic withdrawals make bank failure more likely. But from an individual perspective, once you see others withdrawing, the rational move is to withdraw too, before the bank runs out of money. This is a coordination problem, similar to the prisoner's dilemma in game theory. Individual rationality produces collective irrationality. Now multiply that by every bank everywhere shutting down simultaneously. You would see mass panic on a scale unprecedented in modern history, and panic has its own logic, its own contagious spread. Social psychologists talk about informational cascades, where people make decisions based on what they observe others doing rather than their own private information. If you see your neighbors hoarding food and supplies, you'll do the same, regardless of whether you independently believe it's necessary. This creates a self-fulfilling prophecy. The bank doesn't have enough reserves because everyone assumes it doesn't have enough reserves and acts accordingly. There's also the psychology of trust, which is fundamental here. The economist Francis Fukuyama wrote that trust is the expectation that arises within a community of regular, honest, and cooperative behavior based on commonly shared norms. Trust is social capital. It's what allows strangers to cooperate and complex systems to function. Banking is perhaps the ultimate trust-based institution. You trust that the bank will return your money. The bank trusts you'll repay your loans. The system trusts that most people will act responsibly most of the time. Psychologist Erik Erikson identified basic trust versus basic mistrust as the first developmental stage of human psychology, formed in infancy based on whether caregivers reliably meet the infant's needs. Erikson argued that this early experience shapes our fundamental stance toward the world. Is it trustworthy or not? A functioning banking system reinforces a sense of basic trust at the societal level. The world is reliable, systems work, authorities can be trusted. When banks shut down, that basic trust shatters, and people regress psychologically to a state of primitive mistrust. The psychological impact would vary by generation. Older people who remember the Depression or experienced banking crises in their countries would activate those memories, their fear more immediate and visceral. Younger people who've only known digital banking might experience a more profound disorientation as the only form of money they've really known disappears. There's also the psychology of digital versus physical. Studies show we process digital money differently in our brains than physical cash. Digital money feels less real, which makes it easier to spend, but also creates a certain psychological distance. When digital money vanishes, it might feel almost unreal, like losing progress in a video game rather than losing actual resources. We must also consider the psychology of status and identity. For many people, particularly in wealthy societies, net worth is deeply tied to self-worth. Their bank balance isn't just a number, it's a marker of success, security, and social standing. The phrase worth is used for both financial value and human value, which isn't coincidental. Our language reveals the psychological fusion of economic and personal identity. When bank accounts disappear, people would experience not just financial loss, but identity crisis. Who am I if not someone with X amount in savings? What does my career success mean if the accumulated wealth has vanished? Finally, there's the psychology of meaning-making and narrative. Humans are storytelling creatures. We understand our lives as narratives with past, present, and future chapters. Financial planning is inherently narrative. I'm saving for retirement, for my children's education, for a home. When banks shut down, those narratives collapse. The future you've been building toward becomes incoherent. This narrative disruption can be psychologically devastating, leading to what psychologists call anomie, a state of normlessness, where the scripts for how to live no longer function. The psychological aftermath of banking collapse wouldn't be uniform suffering. It would be a complex landscape of denial, panic, depression, regression, identity crisis, and collective behavior dynamics, all feeding back on each other in unpredictable ways. The economic and philosophical dimensions are important, but it's the psychological dimension that would determine how people actually behave in the immediate aftermath, and those behaviors would shape what comes next. Now we arrive at the economic implications, the cascade of consequences that would unfold if banks shut down tomorrow. This isn't speculation. We can map it with reasonable accuracy based on economic theory, historical precedent, and systems analysis. First, immediate consequences. Within hours, electronic payment systems would fail. Credit cards, debit cards, online payment platforms all rely on banks to process transactions. Gone at the grocery store, only physical cash would work, assuming stores would even accept it given uncertainty about what cash means. Without banks to back it, gas stations, the same problem. Your paycheck, if you were expecting a direct deposit, wouldn't arrive because there's no institution to deposit it into. Your automatic bill payments, mortgage, utilities, insurance, all would fail to process. Within days, the money supply would effectively contract to physical currency only. In the United States, there's approximately $2.3 trillion in physical currency, but total M2 money supply, which includes bank deposits and money market funds, is over $21 trillion. We would lose roughly 90% of the money supply overnight. This isn't just deflationary. This is what economists call a liquidity trap on steroids, a situation where money becomes so scarce that economic activity grinds to a halt, not because of lack of productive capacity, but simply lack of medium of exchange. Businesses would be unable to make payroll, even if they have cash in a safe. Most modern businesses pay employees through electronic transfers. Suppliers couldn't be paid. Supply chains, which operate on just-in-time delivery systems with constant financial transactions, would seize up immediately. The modern economy isn't just interdependent, it's synchronized through constant financial flows. Cut those flows, and the synchronization breaks. Within weeks, we would see mass unemployment, not because businesses don't want workers or workers don't want to work, but because the mechanism for compensating work has broken down. Barter would emerge, but barter is inefficient. The problem economists call double coincidence of wants, I need what you have and you need what I have simultaneously, is why humans invented money in the first place. Returning to barter would be like reverting to 1000 BCE technology in 2026 CE complexity. It can't scale. Food shortages would develop rapidly, not because farms stopped producing, but because the distribution network depends on financial transactions at every node. Truckers need to be paid, warehouses need to process electronic inventory and payment systems, grocery stores need to pay for shipments. The physical food exists, but the coordination mechanism to get it from where it is to where it's needed has broken. The same applies to energy, water, medical care, every modern system. Electricity plants need to pay workers and buy fuel. Water treatment facilities need to purchase chemicals and pay operators. Hospitals need to acquire medicine and medical supplies. None of this can happen without a functioning financial system. We would see not just economic collapse, but civilizational collapse, the unraveling of the complex coordination that keeps 7 billion people alive on this planet. Government would likely declare martial law to maintain order as panic and shortages intensified. They would attempt to create an alternative currency system, perhaps issuing new government notes or transitioning to a digital currency controlled directly by the central bank. But implementation would be chaotic. How do you distribute new currency to hundreds of millions of people without a banking system? How do you determine who gets what especially when old account records are inaccessible. The logistical challenges would be immense. There's also the international dimension. Modern economics is global. Supply chains cross dozens of countries. If banks shut down globally, international trade would collapse. Countries would retreat into economic nationalism and autarky, trying to produce everything domestically, which modern economies cannot do efficiently. Specialization and comparative advantage, the foundations of trade since Adam Smith and David Ricardo, would be abandoned by necessity. Global GDP would plummet. Historically, when financial systems collapse and hyperinflation or currency failure occurs, we see a return to commodity money. People trade gold, silver, cigarettes, ammunition, alcohol, anything with intrinsic or widely accepted value. We saw this in post-World War I Germany, in Zimbabwe in the 2000s, in Venezuela more recently. But the scale of a global banking shutdown would dwarf these cases. There wouldn't be enough commodity money to grease the wheels of the global economy. Most trade would simply stop. Now, the fascinating question: what would emerge from this chaos? Economic history suggests several possibilities. One is local scrip, or alternative currencies. During the Depression, many communities issued their own local currency when dollars became scarce. In our scenario, we might see corporations issuing company scrip, local governments issuing municipal bonds functioning as currency, even large retailers like Amazon or Walmart potentially issuing their own branded currency backed by inventory. These would be inherently less stable and more fragmented than bank-backed national currencies, but necessity drives innovation. Another possibility is rapid adoption of cryptocurrency and blockchain technology. This is ironic because cryptocurrencies are often valued precisely because they operate independently of banks. If banks disappeared, you might see a mass migration to Bitcoin, Ethereum, or newer cryptocurrencies as a medium of exchange. The challenge is that most people don't currently hold cryptocurrency, and acquiring it without banks would be difficult. There would also be infrastructure problems. Cryptocurrency requires electricity and internet, both of which would be unstable in a banking collapse scenario. A third possibility is what anthropologist David Graeber explored in Debt, the First 5,000 Years. A return to credit systems based on personal reputation and community relationships. Before banks, before even money in many cases, human economies operated on credit. I give you grain now, you owe me a debt to be repaid later. That obligation recorded in collective memory or physical tally sticks. It's inefficient for large scale. Anonymous transactions, but works reasonably well for local communities. Where reputation matters and people interact repeatedly, the Austrian economist Ludwig von Mises argued that money emerges spontaneously from barter as the most marketable commodity becomes a generally accepted medium of exchange. His regression theorem suggests that money must originate from something with prior non-monetary use value. If banks disappeared, we would essentially be running this process in reverse and then forward again, regressing to commodity exchange and then watching as a new form of money emerged organically from whatever people found most useful for facilitating trade. But here's the critical insight. Any new system that emerged would eventually face the same fundamental challenge that banking addresses: how to facilitate complex economic coordination among millions of strangers. Banks exist because they solve real problems. They pool savings and allocate capital to productive investments. They transform short-term deposits into long-term loans, providing liquidity. They maintain payment systems, enabling instant value transfer. They assess creditworthiness and manage risk. Whatever replaced banks would have to solve these same problems and would likely end up looking remarkably similar to banks, just with different branding and perhaps different governance structures. You might see credit unions, peer-to-peer lending platforms, blockchain-based decentralized finance systems, community banks, but the functions would be recognizable. The form might change. The function would persist because the function is essential to complex economy. This brings us to modern relevance and systemic fragility. Could banks actually shut down tomorrow? In a literal, simultaneous global sense, it's extremely unlikely. But we've seen regional approximations. Cyprus in 2013 froze bank accounts and imposed capital controls. Greece in 2015 closed banks for weeks. Lebanon recently experienced de facto banking system collapse. These weren't thought experiments. They were real events affecting millions of people. More relevant to developed economies is the question of systemic risk in our increasingly digitized, interconnected financial system. A major cyber-attack targeting bank infrastructure could potentially create a scenario functionally similar to banks shutting down. You couldn't access your money, not because the bank failed, but because the systems mediating access have been compromised. The Bank of England and U.S. Federal Reserve have identified cyber risk as one of the greatest threats to financial stability. There's also the slow-motion version of banking collapse, inflation destroying currency value. If banks remain open but your currency loses 90% of its purchasing power due to hyperinflation, the effect is similar. Your bank balance is accessible but worthless. This has happened repeatedly throughout history and remains a risk wherever central banks finance government spending through money creation. The philosophical and economic lesson is that our financial system, for all its technological sophistication and regulatory oversight, remains fundamentally built on trust and collective agreement. It's more robust than it was in 1929, thanks to deposit insurance, central bank lending facilities, and regulatory frameworks. But robust doesn't mean invulnerable. The complexity of modern finance creates new systemic risks, even as it solves old problems. We've made the system more resilient to individual bank failures, but potentially more vulnerable to systemic shocks. So, what have we learned from this thought experiment? Let's synthesize the key insights across our historical, philosophical, psychological, and economic analysis. First, money and banking are social technologies built on collective trust, not physical realities. The numbers in your bank account are real, only in the sense that we collectively agree they're real and maintain institutions to honor that agreement. This isn't a weakness or fraud, it's how all complex human coordination works. Language, law, corporations, nations, all are institutional facts existing through collective intentionality. But recognizing this should make us humble about the permanence and stability of these systems. Second, trust, once broken, is extraordinarily difficult to rebuild. The psychological trauma of banking collapse persists for generations. People who lived through the Depression changed their financial behavior permanently, maintaining a lifelong distrust of banks and preference for cash and hard assets. The second-order effects of lost trust, reduced investment, increased hoarding, reluctance to cooperate, can be more economically damaging than the initial shock. Third, complexity is both strength and vulnerability. Modern banking enables economic miracles, allocating capital efficiently, facilitating global trade, lifting billions from poverty. But that same complexity creates fragility and interconnection, where failures cascade. There's a trade-off between efficiency and resilience that our financial system hasn't fully resolved. Fourth, the alternatives to banking are worse, at least at scale. Barter is inefficient. Commodity money is cumbersome. Local credit systems don't facilitate large anonymous markets. We developed banking for good reasons. The challenge isn't to eliminate banking, but to make it more robust, transparent, and equitably governed. Now, actionable takeaways. What should you personally do with these insights? 1. Diversify your assets beyond bank deposits. This doesn't mean withdrawing everything and putting cash under your mattress. That creates other risks. But consider holding some wealth in physical assets, real estate, if appropriate for your situation, precious metals as a hedge, even skills and knowledge, human capital that has value regardless of financial system stability. The goal isn't paranoia, but prudent diversification against tail risks. 2. Understand the basics of your financial system. Know whether your deposits are insured and up to what limit. Understand how your bank makes money and what risks it takes. Follow financial news to spot warning signs of instability. Financial literacy isn't just about personal budgeting. It's about understanding the institutional context in which your finances exist. 3. Build community resilience. In any crisis, including financial crisis, social capital matters, strong relationships with neighbors, participation in local organizations, skills you can trade or share. These create resilience that transcends formal economic systems. The communities that survive crises best are those with high trust and cooperation. 4. Think about risk differently. Most people are good at thinking about probable risks and bad at thinking about improbable but catastrophic risks. This is natural given our evolutionary psychology, but it's maladaptive in a world with potential black swan events. Don't obsess over unlikely scenarios, But do maintain awareness that the stable systems you rely on have failure modes, and consider how you'd adapt if they materialized. 5. Support policies that enhance financial system stability. This includes adequate capitalization requirements for banks, robust deposit insurance, central bank independence, and regulatory oversight. It also means being skeptical of financial deregulation justified by short-term efficiency gains that increase long-term systemic risk. Citizens in democracies have voice in these policy choices, and they matter enormously. 6. Remember that economic systems serve human flourishing, not the reverse. When we make bank stability, GDP growth, or market performance into ultimate goals, we've confused means and ends. The purpose of banking is to facilitate human cooperation and improve lives. When the system stops serving that purpose or creates unacceptable risks, it should be reformed. Don't be ideologically wedded to any particular institutional arrangement. Finally, hold the paradox. Yes, banking is fragile and built on collective belief. Yes, money is in some sense not real. But also, yes, these social technologies have enabled unprecedented human flourishing and cooperation. Both things are true. The wisdom is in recognizing the constructed nature of our economic institutions while also appreciating their functional importance and working to make them more resilient and just. Returning to our initial question, if banks shut down tomorrow, would your wealth still exist? The answer is that wealth is always relational and institutional. The real wealth isn't numbers and accounts. It's productive capacity, knowledge, relationships, physical resources, and social institutions that coordinate their use. Banks are one such institution. Critical, yes. Permanent and inviolable, no. Understanding this distinction is the beginning of wisdom about economic reality. If this thought experiment has changed how you think about money, banking, and economic reality, I want to hear about it. Leave a comment below, sharing your biggest insight or the question this video raised for you. Do you think our banking system is more fragile or more robust than most people realize? Have you changed any of your own financial behaviors based on understanding systemic risk? The comments section becomes a community of inquiry, and I read every thoughtful comment posted. If you found value in this deep dive into the philosophy and economics of banking, subscribe to The Economic Philosopher. We explore the hidden frameworks shaping our world every week, blending historical analysis, philosophical depth, psychological insight, and economic understanding to see through the surface of things to the structures beneath. Hit the notification bell so you don't miss future explorations. For those wanting to continue this journey, check out our video on the nature of money, and whether Bitcoin solves the trust problem in banking, or our exploration of historical financial collapses and what they reveal about human nature. Both are linked in the description and the end screen. Share this video with someone who would appreciate having their assumptions challenged and their understanding deepened. This kind of thinking is more important now than ever, as our financial systems become more complex and the risks, both understood and novel, continue to evolve. This has been The Economic Philosopher. Remember, the unexamined economy is not worth participating in. Until next time, keep questioning, keep learning, and keep seeing beneath the surface of the world you inhabit. The truth is always more interesting than comfortable illusions.